Hi, and welcome to your weekly macro roundup. When we talk macro, try to make sense of markets that, they didn't make any sense today, and answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today. Have I got a great show for you today? And I really love the Friday episode because I really enjoy the credit data. And not very many people look at this, and they really, really should, because it answers and confirms so many questions that people have about, is the economy recovering? What's going on? The lending data tells you that. And I really enjoyed Wednesday's episode, or was it Wednesday's episode about, I don't remember, Fed Chair Powell's big mistake, or was that the week? I don't remember when it was. Yeah, I think it was Wednesday, but what a great episode, because it just makes sense when you look at the credit data that he didn't do enough to bring interest rates down. And what did we learn this week? We've learned that 30% of Americans did not pay their mortgage in June. Wow. Now, how do you have an economic recovery, even if all of them, and I know not all the loans will be eligible for that, could stack those payments back at the end? How is that a recovery? What's going to happen when they actually have to make their mortgage payment? And we learned today from TransUnion, the credit agency, that there are 106 million loans. Now, let me be very clear. Not $106 million, 106 million loans in terms of auto loans, credit card loans, home loans, student loans, other loans that are in some form of forbearance, meaning people are not making payments on 106 million different kinds of loans. And yet everyone's talking about an economic recovery. Now, and maybe someone can explain to me, how do we have an economic recovery when people are not making their loan payments? Now, I get that maybe there'll be something where they get stacked on the end, but even if that's the case, they still have to start making them again. And there's a lot of people on the unemployment line, and it appears to be getting worse. So let's jump in and let's go through the economic data. There wasn't any from today. So let's go back and see if there's anything from Wednesday night. I don't think there is. And then we'll hit through Thursday and then jump into the credit data. And let's see if we can find out what is going on in the economy, because that's what macro is. You're always testing and retesting your thesis, looking at the data and seeing, does it validate? Do I need to change? What's going on? So let's do some digging. All right, let's go back to Wednesday. And for those of you who are new, I'm on investing.com. Under news, you can go to economic calendar and you can get this. I don't remember what the other website is, but there's another website that has this. So there's nothing in the Wednesday evening data. So let's move on to Thursday. And we'll find out that we get right into the initial jobless claims. The market was hoping for 1.3 million. We got a little over 1.5 million. It's very unusual that you have an economic bottom with a consistent amount of initial jobless claims that are 1.5 million. And you look at the continuing claims are stuck at 20.5 million. That means 20.5 million Americans are out of work and receiving unemployment benefits. And in less than 6 weeks, that $600 weekly bonus that approximately 50% of the people are receiving goes to zero. That means their unemployment benefit, which is now greater than their paycheck. So if you're making, say, like $50,000 a year or less, the federal bonus made you whole or gave you extra money. At the end of next month, now you're less. So what I expect to see when I see this amount of continuing claims is that at some point people just will stop spending, so that retail sales data, the big bullish move we got, will not repeat, because people are looking and saying, hey, I don't think my job's coming back, or I don't think the hours are coming back. And when that happens, you start saving money. So really curious to see what happens in the weeks that come. All right, let's look at the Philly Fed Manufacturing Index. Now, we can look at the data here, but let's dig a little bit deeper. And one thing you can do is you can click on it, and it brings up this little chart. And what's interesting is most people misread these. And so the way you read this is, in March, it had a minus 12.7% contraction. In April, it contracted a further 56 0.6% from the prior month. Then, as if things weren't bad enough, it contracted again at 43% from that low. Now, right now, everyone says, oh, look, it jumped way up, and they misread how this is. And all it's suggesting is that the index is up 27.5% from those 3 cumulative months of lows. What is that called? A fishhook recovery. Now, one nice thing is you can click on this link here and open up the Federal Reserve Bank of Philadelphia website, and it did, and you can click somewhere and find the June 2020 Manufacturing Business Outlook Survey, which I did. And then you can click over here where it says June 2020, and you get this handy PDF so you can dig into the data and find out a little bit more. And see this chart right here? Totally misleading. It makes you think that everything in Philly is all okay. It is not. It doesn't. While it graphs like this, it is not actually like this. It is way down here, a little hook higher. So let's take a look and see what we can find. From June versus May, again, this is a diffusion index, so it's looking at the month-to-month change. So new orders are up 16% from 3 months of down. Shipments are up. So these are good news that things are starting to improve. They're not improving significantly, but they're improving. So this is good. How about prices paid are up? So we're seeing a little inflation perhaps coming into the Philly factory sector. Prices received are actually up a little bit after being down. Number of employees, unfortunately, down 4%. Average work week, down. So there are fewer, not only fewer employees, but those that are there are making less money. Very, very important. Now, there were some special questions in the report. Was how will your firm's total production for the second quarter 2020 compare to that with the first quarter? Well, no surprise, 77.8% of the firm said we're going to have less production. How about capacity utilization? Now, this is what tells you how much slack is in the manufacturing sector. Because when a capacity is at full bore, then you have inflation. When it's running 80+%, that means the factory is busy. They're going to add employees, add extra hours, shifts, whatever it takes. Maybe even expand. But look at this. Second quarter 2020, percent of reporters, 60 to 70%, 25%. 50 to 60% at 11, 70 to 80 at 33. Remember, just the other day, we looked at the national data, which was somewhere around, I want to say 68.4% capacity utilization. It's echoed here. There is no pricing power in the Philly Fed to drive prices higher. In fact, if anything, this says prices and inflation, or prices are coming down and disinflation, not inflation, is in the report. All right, let's go back and see what else we can find of interest. The U.S. leading index increased. This is, again, a month-to-month report, so it increased 2.8% after being down 6.1% the month before. So, again, the U.S. leading index is confirming the fishhook recovery. Producer prices. Now, Russia's not really a big player in the global scheme of things of what I look at, but producer prices coming out of Russian factories, down 14%. So it just confirms the deflation thesis going on. How about Japan? Consumer price index flat. There's virtually no inflation going on in Japan, so nothing to be concerned about there. And then as we move into Great Britain, core retail sales down. This is May, so this is pretty current data. So their retail sales did jump too, but on a year-over-year basis, didn't improve that much. Regular retail sales on a month-over-month popped, but retail sales on a year-over-year went from -22 to -13. Producer prices coming out of Germany on a year-over-year basis in May, down 2.2%. See, again, deflation is the consistent theme here. So that was it coming into the Friday data. Let's jump into the the assets and liabilities of all commercial banks. This is one of the first things I look at after the market closes on Friday. It's released approximately 1:15 Pacific. And let's take a look, because I know there's not many people get excited about this except me, but look at securities and bank credit. Remember I said the Fed was going to buy bonds? Yeah, they were buying bonds all right. They bought, looks like 22 and $35 billion worth of bonds, quite a bit. And look at what they bought here in Treasury securities. They bought $38 billion. Now they did shed some mortgage-backed securities, but they bought $38 billion of Treasury securities. And remember I said there was going to be a dip in the bond market? Look at that. They bought, let's see, 44, 60, $72 billion worth of bonds in 2 weeks. Now let's go to the chart of TLT, which is effectively the inverse of the 30-year Treasury yields. And between here and here, they were massive buying in bonds. And remember what I said, that this dip seemed like it was manipulated by the markets and the big players were going to come in and buy? There's your evidence. The commercial banks bought and bought. And if that gives you any peace of mind about where the bond market is likely headed and where interest rates are likely headed, it tells you right here. We'll come back to this in a little bit. And I know it's not many people get excited about making a crazy call like that, like I do. But I think it's pretty cool. Anyways, back to the data. So let's see what's going on with loans and leases and bank credit. We're down a little bit. Commercial and industrial lending is down. This is not a real surprise as commercial lenders start to refinance their revolvers or continue to refinance their revolvers. How about real estate loans down $3 billion? Not a good sign at all. Residential real estate down $1 billion. Commercial down $1 billion. How about consumer loans? Flat. Finally, it looks like consumer loans have potentially bottomed out. We'll see. And there was a small increase in credit cards. Not much here going on. Very little. Other consumer loans, automobile loans, flat, flat, flat. So no rebound in the consumer credit data. This is telling you whatever rebounds you're seeing. So that retail sales data was more along the lines of people paying cash, not charging it. It tells a lot about what a consumer's mind is thinking going forward. All right, let's jump into the PowerPoint and continue digging into what we can find in the macro data. And let me get this set up so we can switch between charts. All right, the M2 money supply, I thought it was rolling over. No, it turned out and it moved back higher. 12-month rate of change is 23.74%. The 6-month rate of change is rising. The 3-month rate of change is slowing. But what's going on in the M2? Well, let's go look. So here we have the M2. What is happening? We're seeing savings deposits increase a bit. We're also seeing other checkable deposits at commercial banks increase. So that means money is being saved. So there was a little bit of increase in both those institutional money funds. So it looks like money was flowing back into the market. So this is coming out of brokerage accounts, IRAs, Roth IRAs, cash held in those type of accounts, employer-sponsored plans was reduced but offset by increases at savings accounts. So that's very, very interesting. Let's go back and continue on because remember, from the money multiplier perspective, we want to see the M2 start to slow down and the monetary base continue to rise, but the monetary base actually fell. Now that's kind of unusual, but nevertheless, you probably wonder if I have an answer for that, and I do. And the simple reason is repurchase agreements took a big drop, and that came right out of the Fed's monetary base. So it looks like repo loans, which are loans between the large commercial banks and the Fed, where the banks give the Fed U.S. Treasury securities as collateral for loans. It looks like some of those big repo loans are being paid back. Very interesting. Maybe that has something to do also with the big increase in Treasury securities. I'm not sure if that flips off the bank balance sheet or not, but potentially that adds to the narrative of the banks taking back and holding on to those bonds over the last 2 weeks. They didn't do the math, but maybe I should go back and look. There's probably some similarities to that. So there's the reason the balance or the monetary base fell. Now, is that a bad thing? Not necessarily, because the Fed is still doing $120 billion of QE minimally per month. So there's not going to be a long-term issue. This is a short-term issue as those repo loans get paid off. And as a result of that, the money multiplier ticked up a little bit from 3.49 to 3.58. And that gives you a little hint of inflation brewing, but it's just not sustainable. So as we go and look at the monetary base on a live chart, let's overlay the 10-year Treasury yields. Add that. And you can see, if we zoom in, say a 1-year chart, you can see kind of the monetary base ticking up, and it's kind of putting a little bit of upward pressure there on yields. Is this a long-term issue? No, not at all, because again, the Fed is going to maintain a minimum buy rate. Oh, you were looking at the wrong chart. Here it is, the live version of the Money Multiplier overlaid with 10-year Treasury yields, and you can see 10-year Treasury yields have kind of been pushing up a little bit as the Money Multiplier there. You can barely see in blue is ticked up. Again, not a long-term issue. This is more of a transitory issue, in my opinion, due to the repo loans rolling off. All right, back to the charts. Real estate loan growth is down 3.58% from a year ago. The 6-month rate of change is rising slightly, but look, the 3-month rate of change is about to go to zero. Now, one thing a lot of people do not think is, how can interest rates go lower or possibly negative? How can the 30-year go that low? And like, let me show you the data back from 2008 and 9 and 10. And where is it? There it is. So here is the year-over-year rate of change in real estate loan growth. Same chart we're looking at there. And you can see it went negative in 2009, 10, 11, and midway through 12. And I have in red 30-year Treasury yields, which is what you would expect to reflect the long bond and the 30-year mortgage rate. It had that bottom that I think is coming at some point when we have the next sell-off in the stock market. And then yields went up, and it put downward pressure on real estate loan growth, and downward pressure, and finally it took 30-year yields coming down and 30-year mortgage rates coming down to get some loan growth here. But even then, it wasn't that strong. It didn't have a lot of growth. Now, why is that? Well, I want you to think. Do you remember how far property values fell on average after the great financial crisis? Yeah, 40%. So think about this. If lending growth is what causes our economy to expand, and people were out getting new mortgages, they were getting new mortgages that were 40% smaller, right? Isn't that interesting? So that's what we could see again here, is another big drop in real estate prices due to deflation. And then you see that long-term interest rates not only pop, like I said, but come back down after the fact to try to get some loan growth going. Very, very interesting to see this sort of playing out just as it did previously. All right, back to PowerPoints. Wait a minute. I'm on the wrong thing. Let's see. Are you on the right spot? You are. Okay. Now I'm in the wrong spot. All right. More commercial industrial loan growth down 26.74% from a year ago. No surprise that this should be headed back down. Loans and leases at all commercial banks growth rate is down to 9.54% a year ago. But look at this. The 3-month rate changes at 3.13 and falling. This is extremely recessionary on the 3-month rate of change, which you can't see here, but it's telling you the long rate is coming down and the mortgage market is dragging it with it. Consumer loans, credit cards at all commercial banks flat at minus 7.49% from a year ago. No recovery in the credit card market. Let's go look at another version of that chart, which is right here. And you can see no V-shaped recovery, not even a fishhook recovery. So consumers are not using their credit cards as much as they were. That is a big red flag, because Americans love to use their credit cards. So that is an indication of the health of the economy. Let's go and look at the S&P 500 versus profit margins. And this is kind of one of those interesting charts that was floating around Twitter today by Crescent Capital that suggests that we could be on the cusp of a massive sell-off in equity prices, because profit margins lead the broad market. And you can see the tech bust, global financial crisis, and now everybody's super bullish as the companies they own stock in are going to see their profit margins evaporate. It should be interesting to see how the second quarter earnings plays out, which is going to come sooner than later. So very, very interesting things in the credit data that suggest that things are not as rosy as everybody believes they are, or at least as the stock market is telling us. Okay, so let's move on to, let's look at some charts. And then I've got a question that was right on my mind the other day, and the question came in, and it's really cool, and it opens up a conversation that we need to look at anyway. So let's take a look at a few charts, and then we'll come back to that. We've got the TLT, effectively the inverse of the 30-year Treasury bond, and what's happened is it's holding support at its 100-day moving average. Now, I'm not, as I've said before, I do not trade at moving averages. The people that do, I'm not big on that. But what they do act as a level of support. And what we can see is as bond prices fell down to the 100-day moving average, buyers came in, and now it ticked right back up over this little level of resistance, and we can zoom in and see that dashed purple line was right on the mark. So we had this was originally support because prices held, then it broke, and then it came up and was resistance, couldn't get through, resistance, couldn't get through, and then finally got through. So we'll see. But knowing the banks are back holding a massive amount of bonds again, and probably going to add to that, it does put upward mobility on the long bond because, again, the Fed's still buying 30-year bonds. In fact, they have two auctions next week, two QE auctions at, I think, around $1.75 million apiece. And what do you think the banks are going to do with their bonds? They're going to try to get the bond prices up because that's how they make money on it. They don't mark them up to the Fed. They get the bond market to move up by eating up all the supply, and that drives prices higher. So I think that is coming sooner than later. Now let's take a look at the dollar index. It also rallied, and right now we're seeing the long bond fairly strongly correlated with the dollar. And I've added some supply zones to this because this is pretty interesting to me. And we can see the dollar has been in this really long consolidation pattern. Now, either you believe that this is a top, that this is a long topping structure that moved up here, or there's a final move higher that just destroys the equity market, and then this all comes crumbling down as the Fed just goes berserk with quantitative easing. At the moment, it doesn't lead itself to say it's a top or a bottom. It just tells you there's a continuation pattern. But given the status of world dollar liquidity, it's more likely that the dollar is headed higher. We also know that because quantitative easing causes the dollar to go up. And so it bounced off of this supply zone, one that's been just hit repeatedly, and now it needs to break into the next one. It ran into resistance. We'll zoom in a little bit. You can see it ran to resistance or above this next supply zone. So we'll presume that it'll try to break into there, or it'll come back down and tag the top of the prior supply zone and then make its move up here. If it gets over the 103, there's your massive dollar spike. There's your equity wrecker, and it gets very interesting from there. How about emerging markets? It's past the line of doom, but still not gaining any traction. Again, I do expect emerging markets to make a big move down again, along with the dollar making its move higher. And with that, we also see gold miners, which I've claimed are going to reverse direction. We'll see if they get down to their prior lows again. But we see at the moment what appears to be a topping pattern. It'd be interesting to see Monday if speculators are backing off their longs or not. Okay, let's come back to that after we hit some questions. I've got just two because, well, you're going to have a lot of questions answered this weekend. All right, I'm following you from Chile. Hey, right on, our first viewer from Chile that I know of. Great insights and remembered a few classes of macro at uni. Awesome. Two questions. Should not the dollar liquidity cycle look as well at the export side from the U.S.? No, it shouldn't. I would think that one of the biggest points the U.S. should look at to boost back the economy, right? What is the impact now, and what do you expect in the next following months? No, the U.S. exports are irrelevant, because in the world dollar liquidity cycle, what are we trying to export? Dollars, right? That doesn't show up as an export. We're trying to export dollars. So what do we want to look at? Imports into the United States, and then exports from major exporting nations. So I want to look at exports particularly coming out of Asia, China, South Korea, Japan. I want to know what's going on there, because when they export, where does a lot of that stuff come? It comes to the U.S., then shows up in the U.S. import data, and then that tells me we're exporting dollars. So no, I don't really concern myself with U.S. exports other than when you have both imports and exports shrinking, that tells you the economy is also shrinking with it. All right, let's see what else we've got. In this low rate environment for companies, it's easier to borrow money, and it would be easier for defensive and, of course, non-financial stocks, at least a few, to maintain a mild dividend and therefore provide higher earnings than bonds. I'm thinking about utilities, hardware companies, defense, etc. So why should these stocks fall, providing standard, maybe lower returns than the ones in prior years, but higher than bonds? Because dividends do not keep stock prices up. Now, the coronavirus has really wreaked havoc, and we're not going to know a lot of the details, presumably, until we see second quarter earnings. But it's going to be really hard for a lot of companies to justify borrowing money to pay a dividend when they have negative cash flow. So I'm going to expect to see dividends trim back. But in a deflationary environment, the price of the stock can still fall regardless of the dividend. And when that happens, you're effectively buying yourself an annuity, because or you should have bought an annuity maybe in that case, because you've got the dividend, which can get cut, but now you have less money. So let's say the stock price gets cut in half and you go, well, I still got the dividend. Well, go check GE stock and tell me how the stockholders felt about the dividend when it got slashed after the stock price tanked. So no, dividend stocks are not immune to deflation. All right, I've learned so much from your podcast. Here's a question from your recent marathon. I've been watching all your videos. Information you can't get anywhere else for sure. Look, I'm sure you can get it somewhere else, but probably coming with a fee. This is free. So you get what you pay for, right? You answered a question this week about a refresh on when you expect the markets to test or fall below the March lows, and you said you were going to push back your prediction out a month, but I haven't been able to find your original position. Would you mind telling us again when you expect that to happen? Do you think this is soon, before the election, perhaps? Yes. In fact, this is interesting because big friend of the show, many of you know, Dr. Chris Dark, who hosts the Dr. Dark After Dark podcast, and I were just talking about this, seemed like 24 hours ago, before this question came in, and that's what you do in macro. You start looking ahead and saying, okay, what's coming that I might need to know? Does it change my thesis? What's my view on this? And then this question came in, so it was perfect timing. Let me finish the rest of this, and we'll go back and look at some charts. Thanks again for expanding my mind. I never really knew before what macro meant and how powerful the information can be. The story about your data was particularly impactful. Well, thank you very much. Glad you're enjoying the show. So let's talk about my original prediction was around 90 days, and I think that was about 60 days ago. So I'm pushing that off a little bit more. And in the macro world, I don't quite worry about that. But do I think a retest of the March lows is out? No, I don't, actually. So let's take a look at the S&P 500. And here's the March lows. Now, there's another interesting thing that Chris and I were talking about, is a potential, what if there's a head and shoulders bottom? And let me zoom out, and could be a left shoulder, a head, and what if there was a right shoulder, say around 2350? In a proper head and shoulders bottom, it would need to be the same time frame, and this was in December of 18, so that would imply that we would need to see about a 15-month move down. Don't think we're going to see that. So I'm going to stay with my double bottom here. And if we get a double bottom, it's going to be massively bullish. And it would be even bullish enough for me to say it's time to buy stocks. Now, I'm not going to obviously say that on the show at that time. But that does not mean I don't think interest rates make a large move down. Remember, when we look at the 10-year Treasury yield, we have to zoom out pretty far. This is the largest topping pattern here. This topping pattern began back in 2012. So somebody was accumulating all these Treasury bonds with the intention of making a profit on them, and now everyone believes that this is the bottom. No, this thing's got to go down some more. And the Fed's going to have to do a massive amount of QE to absorb all these people that want to sell that were buyers. So I still believe there's a move down in yield. But the question is going to become is, where does the stock market go? Do we get a double bottom, or does it blow through like we saw with the profits expectation where it goes lower? What I know is the next bottom is going to be extremely, extremely enticing for me, because it's going to yank out a lot of speculation. And the data says a lot of money managers did not participate in this rally. And here's the thing about double bottoms or large bottoming patterns. You don't have to jump on the first train, because almost every time you see a major market bottom is two bottoms. What that does is it reduces your risk from a macro perspective. It flushes out speculators, gives you an opportunity to come in. So yes, I'm very, very interested in that. We'll see how it plays out. Anyways, thanks for watching, and I hope you enjoy all the Q&As this weekend. And with that, we now cleared the deck with questions, so we're all set fresh for Monday. I'm Steve Van Metre. Appreciate you taking the time to watch, and I will see you on Monday. Bye now. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.